Okay, and I have the really amazing pleasure to introduce you to Marcia Dawood. Marcia actually was a former boot camper and is part of our community and a dear friend, somebody I have so much respect for and care so much for. And she's an angel investor, an SEC advisor. The woman's a rock star, podcast host, TEDx speaker. I mean, how many things can you attribute to Marcia? I don't know. But the book that she wrote was Do Good While Doing Well. And it's a really great book. It really talks about how we can use our money to do good things in the world and even get a return. And so she'll talk about a lot of those things. And her podcast is called The Angel Next Door. It's a really well done podcast. It's informative, no commercials, which is my favorite. And you know, it really, I learned so much. Every podcast, I learned something about investing and the finance world. And many of you don't know this. I am so curious about investments. And, you know, my husband talks about all these things and, you know, I'm kind of slowly trying to catch up, but I really have a desire to learn more. And I'm learning more through Marcia's podcast and reading her book, and it's fascinating. So we'll make sure that you have all those links for that. But she's really committed to expanding support for diverse companies and overcoming the world's biggest challenge and problems and accelerating positive change. And so not many people are like Marcia, and we want more people like that in the world. So Marcia, I'm going to turn it over to you, and we're going to have this interactive dialogue. But before we get started, kind of fireside chat format, tell us what made you want to write the book?
Yeah. So, hi, everybody. Good morning. It's still morning here on the East Coast, too. So, morning, everybody.
Yay.
Um, so, in 2012, I was invited to an angel investing meeting. And I remember thinking, cool. Like, but what's that? Like, I have no idea what angel investing is. And I really don't know why I would ever go to an angel investing meeting. However, I quickly found out that that is where people gather together so that they can evaluate various startup companies, private, early stage companies with entrepreneurs who are doing like really cool, innovative things. And so I went to the first meeting and I was totally fascinated. I lived in Pittsburgh, Pennsylvania at the time, and I had no idea that any of this was going on right in my own backyard. And I thought, wow, I could be a part of this. Like, I thought that angel investing, I didn't really know what it was or anything about it. But if somebody were to, like, ask me what I knew about it, I guess I would think it was for people who were super rich, maybe like what you see on Shark Tank. You'd have to have a finance degree, you'd have to be invited, you have to live in Silicon Valley, all the things. And so I definitely did not think this was something for me. But I certainly very quickly found out that there are entrepreneurs in every city, in every town, all over the world. And therefore, there are people around them who are the funders, the advisors, who are hopefully there to help build the company up. But I quickly learned that there's not that many people that really think they can get involved because, like me, they think, well, I have to be rich, I have to be famous, I have to be this, I have to be that. And so I thought, well, we need to demystify this because there's all these things that have been going on, especially in the last like 5 to 10 years. How do we get more people to know about it? So that's why I started the podcast in 2021. And then I spoke at TEDx Charlotte in 2022, and people were like, oh, okay, we're starting to get it, but it's kind of hard for you to explain it to us in 11 minutes. So can you write a book or like give us some more information? And so that's kind of where the book came about. It's really the demystifying of what does this all mean. So it's not a book about term sheets or due diligence or I mean I mention what that is so that you know, but it's really just breaking down like what does this even mean? Is this for me? how can I do this? How much money do I have to have, and all that kind of stuff.
So, angel investing, and you and I talked about this. So there's, and on one of your podcasts, I can't remember which one, but it talked about ways for us to direct donations, like in donor advised funds. But that's not an ROI thing. That's really, how do we donate our money to do good things in the world? Can you talk a little bit about the donor advised funds? Because I one of your podcasts talked about you can pick a fund manager of donor advised funds and then make sure that things are managed rather than you just individually pick these charities.
Right. So let me kind of explain the whole thing. And I actually do have a podcast episode that's called Investing with Philanthropic Dollars Explained in 7 minutes. So if you want to hear about
And
this
it's good.
in 7 minutes, you can get the whole thing. But I'll try to do it like 2 minutes. How about that? So a donor advised fund is where you would put money that would be eventually given to charity. It's a little bit like a bank account, for lack of a better term. It's like a philanthropic checkbook. You put the money there. You immediately, as the donor, get the tax deduction. But then you can take that money down the road and you can parse it out. It was really, I mean, since it's just us talking here, it was probably built for people who were relatively wealthy, who might have had a big like bonus one year and they want to take a big tax deduction in that year, but they don't necessarily want to donate all the money out in that year. So it's like a holding spot. Well, most of the time, if you do this through like a Fidelity or Morgan Stanley or something like that, those people who at Fidelity would take the money and put it into a money market account or a mutual fund or whatever you decided, so that the money would have the opportunity to grow while it was sitting there. Now, believe it or not, there are about $300 billion sitting in donor advised funds. A lot of money sitting there. If you put your money into what I call a self-directed donor advised fund, meaning that there's the custodian, the Fidelity of the world, but not Fidelity because they wouldn't really do that. If you put it somewhere where they would actually let you invest into a for-profit company, that money can grow the same way it would if you invested it into a mutual fund, except now you're helping a hopefully underrepresented founder, or you're helping somebody who's making big change in the world with a for-profit company. Now, let's say that that company does really well. And that money would then go back into your donor advised fund. But you, as the donor, you're not going to get to take it and go buy a car or anything like that with it. But it does mean that you now, instead of having, let's say, $10,000 in your donor advised fund that you could give to charity down the road, you might have $20,000 in your donor advised fund, or whatever the story is. So it is a way to accelerate your charitable giving and also be able to help for profit companies along the way.
So, but are there any tax implications if the money grows and,
No, not to
okay,
you. You already
not to you?
you already got the tax benefit when you put the money into the donor advised fund. That's when you immediately get the tax benefit. And then there's no tax implications of any kind after that.
So, and then there's the companies that, well, angel investing and the whole potential of a return on your investment. So I want to talk about that, and I also want to talk about like how people can get involved with the companies that they invest in, because so many people are interested in becoming advisors to startups, and it sounds like this is a way for those of us who are interested to really get involved, to make, an investment and to get involved with the company to help them be successful.
Right. So angel investing, just to back up for a minute and explain like simply what it is. It's when someone writes a check, usually out of their own checkbook, to invest in a private company. It's as simple as that. You're investing in a private company. Now, if you go onto E-Trade or Robinhood and you're buying stocks, that's the public market. That's very, very regulated by the Securities and Exchange Commission. Don't look at it today, by the way. Um, and because it's not doing very well today, or yesterday. But anyway, so the public markets, you could buy a stock and you could then turn around and sell it very quickly, like within 30 seconds if you really wanted to. The private markets are totally different. When you invest in a private company, you are holding that stock in the private company until there is some type of what we call a liquidity event or an exit. So that's when your money would actually come back to you if there was a positive exit, meaning you were getting a return, or if the company goes out of business, that would also be a liquidity event. Except there's no liquidity because you would just basically take a tax write off on that. So that's like simply put how angel investing works. Now, sometimes companies will need advisors, and some a lot of times advisors are people that have put in money and are also investors, but not always. Sometimes it could be that a company is in need of someone who has a very specific type of expertise. So think about a healthcare company, and that healthcare company has something very specific that they're working on, and they need a specific type of doctor or PhD person who really knows about that. That might be an advisor for that company, and in exchange for their advisement, they get some part of an equity like option plan. So that's another way that people can get involved, and sometimes people do both.
So, the, but it's risky, right? I mean, it can be.
Angel investing is definitely an asset class that is risky. And so at the Angel Capital Association, where I sit on the board, we say that people should usually only invest about 5 to 7% of their investable assets. So this is not something where you want to take your kids' college education money when they're 15 years old and put it into that, because you just have no idea when there will be a liquidity event. Sometimes it can take years, sometimes it never happens. But the way to start to at least de risk this a little bit, and remember, I'm not a financial advisor, I'm not making any recommendations, and I do not represent anything with the SEC, or I have my own opinions, blah, 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 all the disclaimers, right? So, but with the way that the risk can be actually minimized is to diversify your portfolio, because basically what we say is that out of 10 companies, probably 5 or 6 of them are going to completely fail, meaning you will get none of your money back. One or two of them might do okay, and then you're hoping for that one or two that does really well, that will return all the money that you put into all the companies combined and then some. So that's kind of the idea when it comes to the returns. But what I talk about in my book a lot is like, why would somebody want to be an angel investor? And part of it is because of the returns. There is a potential. I mean, I've had exits before where I got back 10 times the money that I put in. That doesn't happen super often, which is why you diversify your portfolio. But at the same time, you are also trying to do good in the world. So that's really why I titled the book the way I did, because you're you're doing it for more than just a financial return. If you really cared only about uh, investing for a financial return, maybe you'd be like a day trader or something like that with the stock market. But this is more like, what do you care about? What are the things that you would like to see change in the world, and how can you be a part of that? And then also, I got to meet people like Christy, that I would have never met otherwise. And that to me was really fascinating. I worked in corporate America for 17 years with the same company. I had the same friends. I just, I had the friends in my like local community. Um, and I had the friends at work, and that was it. There was really not a lot of an other way for me to meet people. And here with angel investing, not only am I meeting different people, but we're working on something together. We're making a decision as a group, usually. That's the best way to do it. You don't really want to ever make decisions by yourself. But you're making a decision as a group and you're getting to know each other pretty well because you're talking about something that's very specific. It's not like when you go to a dinner party or a cocktail party or whatever and you're meeting people and it's just kind of, oh, how are you? Who, what do you do? What do you know, that kind of same old kind of boring conversation. This is like you're actually talking about a company, what they're doing, that people, really care about their mission. And so this is something that when you're thinking about whether or not you want to get involved in angel investing, you're thinking about all the aspects of it. Why is it that you'd really want to do it? And is it something that would really fit into your personal portfolio?
So Bill Lazor asks the question, what's the minimum amount you would need to participate in angel investing? And it sounds like and what qualifications?
Yeah, that's a good question. So, back in the day, you used to have a lot of money. Like, if you wanted to invest in a fund, it was probably 250,000, if not $1 million. And if you wanted to invest directly in a company, it was probably at least 25 or $50,000. That is completely different now. You can invest through equity crowdfunding for as little as $50, $100, which I love this so much because people can kind of dip their toe in the water, learn about it, get their feet wet. They don't really have to put a lot of money at risk. I especially like it for the younger generation because it's something that they can learn with using very little money. And you really don't have to invest anything. These are public online platforms. And you could basically do an online search for equity crowdfunding platforms, but I'll tell you the three that have the majority market share, and that's WeFunder, Start Engine, and Republic. So if you go to one of those, you can look around at all of the different types of companies that are fundraising, and you can learn an awful lot without ever making an investment, which back when I got started in 2012, that didn't exist. Equity crowdfunding only exists because of the Jobs Act, which was passed in 2012, but the equity crowdfunding piece didn't get activated until 2016. And then it took a while for these platforms to kind of, get to a point where the user interface was good, that people could actually, find it, that there was a kind of a critical mass of people using it so that it would be, there'd be a lot of information on there. And nowadays, you really can get a lot from that. So that's one way. If you wanted to invest, even today, directly into a private company, you do have to be what is considered an accredited investor. An accredited investor is an SEC definition for someone who has the wealth and income level to be able to, I guess you would consider it, tolerate the financial risk. So you have to have 200,000 in income yourself, 300,000 if you're including a spouse or a partner, or $1 million in net worth minus your home. If you meet this and income qualification, then you are allowed to invest as much as you want. Now, I do sit on a Securities and Exchange Commission advisory committee for small business capital formation, and we have talked at length about this definition. I personally don't really care for the definition, and as a committee, we went to the SEC commissioners and we actually made a formal recommendation for them to add some sophistication to this so that there was an education component. Because just saying that somebody has a certain amount of wealth or income doesn't make them a smart investor. And I don't care how much money they have. So, and by the way, people can go to the horse track or like a casino or they'll play the lottery and they can use as much money as they want. So it doesn't really seem fair that people who don't meet that threshold can't invest, but the people who do can, and they can invest as much as they wanted. So it just, I don't know. I'm not a huge fan of the rule. I think there needs to still be a little bit more to it.
So in your book, you talk about fraud versus how do you evaluate? I mean, I think about these platforms and it's like, couldn't anyone just say, here's a company? And so what kind of safeguards do people have with these smaller companies and these websites that you can invest in these companies?
Well, even to get onto the website, there's a lot of diligence that has to happen. So the all of these online equity crowdfunding, I'm not talking about Kickstarter or Indiegogo or GoFundMe. Those are not equity crowd. Those are crowdfunding sites, but they're not for equity. The equity crowdfunding sites are regulated by the Securities and Exchange Commission, and there's a lot of information that has to be put onto the platform before somebody can invest. So there's a lot of diligence that has to be done on a company. Now, could somebody either on a platform like that or even to an angel group, could they be fraudulent? They could. I mean, we did see it with Theranos. That was a big a big news story that was actually somebody who committed fraud and she went to jail. It isn't something that I've seen ever in my own personal and angel investing, and I've been doing it for a long time, and I know pretty much all lot of the angel groups in the U.S., and I don't know of anyone that's ever had something like that. I think there was a fund once in Texas where they thought the fund manager was fraudulent, but I mean that's like one instance of thousands and thousands. So, um, it's fraud isn't really something that that we run into, and a lot of that is because of the diligence that is done. So, like I was saying earlier, you don't want to necessarily have one person make a decision. Like if I was going to say, "Oh, I want to invest in this company," and I was the only investor, that's not a good thing to do. But if I am investing with my angel group or local angel group or with through a fund or something like that, there are multiple people involved in the diligence process, and there's a long checklist of things that we go through and look at before we actually make a decision.
So, and that's comforting. And then I think because that's part of the fear, right? It's like I think many of us want to get involved in things like this in small companies, but I mean, personally, I think, well, am I just throwing my money away? How do I make sure that I'm investing in something that's legitimate? The and I can't remember who it was, but one of your podcasts, there was actually I think she was a fund or a wealth manager, and she talked about the attitudes of money why people don't invest, and not that they don't have the money, but they have a fear about the investment. I don't remember a lot of the details of the podcast, but I do remember this woman that you talked to that talked about just, people want to know more to feel more comfortable. And they also have to look at their attitudes about money.
Hmm. Yeah, and this is a really big topic. I mean, especially for women, and I don't mean to generalize, but I will here for a minute. Um, we haven't been conditioned through, for centuries really, to be financially literate. That was always done by the man. If you think back even like to the whole dowry system, eons ago, and how like just the where we've come from when it comes to financial literacy and how people feel about investing. And everybody has their own relationship to money. And in a lot of cases, it even comes from money trauma that was either through the family that they came from, or maybe they had some of their own when they were younger. So, yes, everybody's risk tolerance is going to be a little bit different. And so I think the more, basically what you said though about the more education that you have, the more that you know about how to mitigate risk, that I think is where people start to get more comfortable and then they're more willing to take part. What I worry about happening is there are a lot of people who are going to end up coming into quite a bit of wealth during this big wealth transfer that's going to happen between 2030 and 2050. And a lot more women are going to end up coming into more money that they're going to end up managing. If they keep too much of that money in cash, some women could end up outliving their money because they haven't invested it properly to be able to have it spit off income for them. Not all. I mean, every investment has risk to it, but every investment has a different level of risk. And so I think that's why, in a lot of cases, if you're not comfortable with it, getting a financial advisor who can help. Um, I just would caution with financial advisors that you find somebody that is aligned with your goals and values and not necessarily with just their own. I've heard too many stories where people said, well, I had no idea that I was actually paying these exorbitant fees to my money manager. And the fees didn't really look like that's what they were paying, but they were because the products that their money was being invested into were actually spitting back fees to the financial advisor. So I think that's something that you need to take a look at too.
And as I recall, that podcast opened my eyes in so many ways. It's so it you know kind of a side topic, but money managers, to focus if they're not product specific, they need to be product agnostic, and that's kind of what we're talking about. Dove asks, are you and your group investing pre-seed, seed money? Are you typically a lead investor?
So I've been involved with several groups and funds. So I'll just give you an example, like with Mindshift Capital, we were investing at the seed, pretty much the seed and the Series A rounds, and maybe once or twice out of the 15 companies that we invested in did we lead. But in a lot of cases, it's the group or the fund that is writing the biggest check, kind of writes the terms or figures out the terms, and that's really what's considered to be the lead investor.
And then I really want to talk about how do we evaluate different companies, and and then how do we get involved? So let's talk about the evaluation. So we go on to these websites and we look at the different companies, and what are some of the things that we should be looking at?
So and you can spend hours and hours and hours and hours and hours and hours doing diligence on a company. And, in some cases, people think, oh, I really need to spend so much time looking at their financial projections, and that's going to take so long. And I don't really know a lot about financials. Um, Actually, financial projections are probably like the last thing I look at, only because these are early companies. Like they can write on paper whatever they want to. It doesn't necessarily mean it's going to be true. What I'm looking at is what is the problem that they're solving. And in a lot of cases, I see entrepreneurs that have these like amazing solutions. They're so excited about it. They're like, oh, look at this thing I built. Oh, it's amazing. Everybody's going to want it. Everybody's going to buy it. Everybody wants to pay for it, everything. Okay, no, so not always. But is the problem that they're solving with their solution, their wonderful thing, is it actually solving a big sticky problem that people are so frustrated with that they will change their behavior and use your solution in order to solve the problem? So that's really one of the things I see with entrepreneurs that they can't quite articulate well is the problem that they're solving. And that should be the first thing that they're talking about when they're pitching is what is the problem and why are they solving? Why are they the ones to solve it? And the best cases that I've seen are when the entrepreneur had the problem themselves and they went searching and searching and searching for a solution and they couldn't find a solution. So they're like, well, if I can't find a solution, then I'm going to make it myself. The other thing is the team. So, in a lot of cases, entrepreneurs are visionaries. They're super good at thinking through things, being able to come up with ideas, thinking about what it'll be like. Sometimes they're not the greatest executors. So, it's really important that they surround themselves with the people that have the type of skill sets that they don't. And so that's when you can really see if you have a solid team worth investing in. If you're talking to them and you realize that each of the skill sets kind of around the team are complementary and not necessarily all the same. So think about the tech company where a whole bunch of programmers got together and now they're the ones who are running the company, but there's nobody actually doing anything besides programming. So who's going to sell? Who's going to uh, build the company as far as operationally? Who's going to do the hiring? All the things. So those are things to think about also when you think about looking and evaluating company.
So how do you get involved? So what I think about is if I find a company, because you're right, it's all about execution. It is all about execution. There's so many people that have great ideas and then they build this great solution. They just can't execute on it. They can't sell it. They can't structure a company. They can't do any of that. So I'm a bit of a control freak. My team would tell you that that's true. And but I would want to get involved. How could I get involved with a company? I find it online on one of those sites that you mentioned, and then I want to invest, but I want to talk to somebody. Is that possible? And is there a way that I could even get on the advisory board? Because, there are so many companies that need good advisors. And for some companies, I think I would be a great one. And I'm sure that there's lots of people in our community that would be great advisors. How do they get involved?
Okay, so two things with that. One is you mentioned about on the platforms for equity crowdfunding. All of the information between the company and the investors or potential investors is all public on the site. So let's say that you were interested in getting in touch with the founder or the CEO. I mean, you can message them right there on the site. And if you were interested in potentially being an advisor, you could say that. So it's very transparent being able to interact with the company through the website. And the other thing is once an investment's made, the interaction continues through that online platform. So let's say that the company is like, hey, uh, our product is ready, whatever it is, XYZ widget, and we are now looking for introductions so that we can sell into Target, Walmart, you name it. They could put that out there, and basically now their entire investor base from the equity crowdfunding site could potentially help them, which is another way that it's great if you're an entrepreneur and this is one of the ways that you fundraise. You're also getting access to people's network. Hopefully you're building a good customer base too, because now you have all these investors that are really caring about your sales. As far as being an advisor, though, to a company that maybe isn't through equity crowdfunding, maybe you find them in your local community or through your angel group, that would be something where if you became an investor, you would talk to the company about whether or not, what their needs were. So, for example, there was a company once and they asked me if I would be actually a board member. And when I looked at who else was on the board and what the company really needed, I really wasn't the right fit. They needed a very specific skill set that I did not have. So we went and found that company the right person. So in some cases, yes, I would totally agree, Christy. That you would be an amazing advisor. Um, you also want to make sure though that you're bringing the skills that company needs at that time. So just so that you're not either wasting your time, their time, or anything like that.
So you talked about the local community. So how would you, okay, so if you look in your community and look for angel groups, I think here in Orange County we have, is it TCA something? Used to be Octane. I don't know. Bill, maybe you know something about that. But there was a group called Octane, and then they changed to TCA, which is something about angel investing. And but how do you find these angel groups? And then how do companies, startups and stuff find the angel groups to request funds?
Yeah. So I always tell people just go do a Google search like startup events near me or entrepreneurs near me. A lot of things will come up about what's going on in your local community. I always say start with your local community because if you don't know what's going on in your local area, like, I don't know, maybe you wouldn't care as much if it was farther away. Plus, you can go see them in a lot of cases. So that's kind of how I got started is I learned about what was going on, around me. And so I think that that's a really good way to start. And then also angel groups are the same way. They're all online usually, especially now since COVID. And then if you go to the Angel Capital Association's website, which is just angelcapitalassociation.org, there's a whole list of angel groups throughout the country. So there's a lot, like hundreds.
So let's talk a little bit about why companies fail. So these startups, and you mentioned one, it's the team, but what else? Why do companies, some of these startups fail?
Well, if you ask people, most angel investors would answer that question by saying they fail because they run out of money. But I think it's deeper than that. Yes, that on the surface is why they fail. They run out of money. But what ends up happening is in a lot of cases, companies will raise money. And so they go out, even at the very beginning, like with their napkin and like their idea on the back of the napkin of what they want to do, they raise some money. But if they can't hit milestones to show that they are worthy of raising more money and then hit more milestones so that they can raise more money, that's when companies start to get in trouble. So if they get a little too over anxious at the beginning, raise some money, but they can't execute on the idea, back to execution, then once it's time to fundraise again, if they haven't actually gotten to the point where they said they were going to get to before they would fundraise again, then the confidence of the investors is going to go down. And then it's kind of like a downward spiral from there. If they can't fundraise, that means that they are going to run out of money. They're not going to be able to pay their people, and then everything kind of goes south. But was it really that they ran out of money or they just couldn't execute from the beginning? So again, it's going to come back to execution.
Yeah, I think that, even companies have struggle with their bottom line because they don't have people that can execute. One of
Hmm.
my personal focuses and pet peeves too. So Tina Kobeski, and Tina, I'm really glad that you're on this call. Tina is always very interested in ESG, and so she asks, how do you find the companies that are doing good, have positive impact, either social or climate impact, et cetera?
Hmm. Yeah. So, in a lot of cases, I would say, looking for companies, and that I wish there was like a better matching system for how we could match companies to investors. And there is actually a company that my friend Allison Byers runs. It's called Scroobius, and I can put it in the chat in a minute. But it is a matching platform for angels and entrepreneurs for underrepresented founders. So mainly women are on the platform. And in a lot of those cases, you're going to find that they're working on companies that are doing good in the world. So, but I really think it's a matter of like if it's something that you care about and it's something specific. So, like for example, my mom passed away from ALS, so I'm very interested in companies that are working on treatments or cures for this disease. Then I'm connected to other people either through LinkedIn or just my own network of people who are working on some of these things. So I think if you have something specific like that, you can actually go out and find companies or people that are interested in that, and then that will lead you to companies. So, that's kind of one of the ways you can do it.
That's really interesting. I think that so uh, the Angel Network sounds like a great place to start. What about incubators? I've really been curious about incubators because, especially for our business, I feel like, if we met some great companies through incubators, we could, really help them with resources as they grow and need it.
Hmm. Absolutely. So, um, definitely in the early stage space, there are incubators and accelerators. So there's kind of the same thing, but they're a little bit different. Usually, an incubator, not always, but usually, has has the idea that you would actually go like have real estate at a place, you would work there, you would be very integrated into a group that would also provide mentorship and things that you would need in order to grow and scale your business. An accelerator is a usually a short program. It can be through something like Techstars or Y Combinator, and they're going to really put a very specific timelined program together in order to help a company grow and scale. So I'm a fan of these because I really think that there are a lot of times that I have seen companies go into an accelerator program, for example, and come out with a completely different um, idea. They've kind of pivoted the idea. They've pivoted their idea around the team and everything like that, and they're in a much better place. So the mentorship and the guidance that people can get in these programs is actually very, very helpful.
So Alan Switowski asks, as an angel investor, how do you measure success in the short term? For example, ROI, sales revenue, change in the community, doing good work.
Yeah, so I think in a lot of cases, as you're making investments, you need to talk with the company about how A, they're going to report back to you about what they're doing, and B, how you're going to measure that. So, for example, I am on the investment committee of a fund called the Next Wave Impact Fund. So we invested in 15 companies, all around social good. Really, it was either people or the planet. We spent a lot of time talking about what impact actually means. But at the end of the day, what we were really trying to do is prove that you could have that you could make an investment, get a return, and you could also do good in the world. Well, each of those companies that we invested in, we sat down with them as we were making the investment. So at the beginning, and we decided what metric we were really going to look at in order to measure how good they were doing in the world. Did that mean units of sales? Did it mean people affected? Did it mean customers? Like what exactly did that mean? And in a lot of cases, we were trying to tie to the sustainability goals, the UN sustainability goals, and so that was really one of the ways in order to do that. Now, if you're talking about like overall, it can be hard because this isn't something that you're going to get regular reports about. You hope that that's what's going to happen. In fact, I would highly encourage you, as you're making any new investment, to get something in writing from the founders saying that they will be giving quarterly updates at a minimum. One of the best founders I saw, he would send out an email every month. And I think he kind of kept like just a notebook on his desk. And every day, at the end of the day, he'd write something that happened. And so at the end of the month, it was super easy for him to just put it in an email. And he didn't send it just to the investors, he actually sent it to everybody who knew the company. And it was great because everybody always felt like we were in the know about what was going on with the company. And every time if he needed something, he'd ask. And I thought, this is pretty genius. Like, it's so simple, it's so short, it doesn't take a lot of time. Every entrepreneur should be doing this. And in a lot of cases with my own portfolio companies, I have to track them down. I have to like hunt them down. I have to like, basically like, you know, try to wrangle them in so that I can get information about what's happening in the company. So that's something that up front you want to establish early on, the cadence of the communication, because what you really don't want, and I see this happen all too often, is the founders will be great while they're raising money, very communicative, and then all of a sudden they've raised the money, they're gone, and now they need more money, and that's the only time you hear from them.
Okay, you mentioned that you keep track and then you sometimes have to hunt them down. I mean, what tool do you use to track like who you've invested in and what the status is? What are you doing to track all of that?
Yeah, unfortunately, I just keep mine on an Excel spreadsheet, which is not great. And there's some softwares nowadays that you can use for it, but the best thing to do is have the company actually put all of their stuff on Carta. So if you are familiar with Carta, that's where you are a lot of ways that you can keep track of the company.
Interesting. So let's see, are there other questions? Who else has some questions? I can monopolize this for the full hour. Who has questions?
Yeah,
Oh yeah,
tell us
thanks,
say
Karen.
a little bit more about Carta. This is the first time I'm hearing about that. That's CARTA.
CARTA, yeah. So Carta is a company that they're basically a uh, stock management company. for lack of a better
Okay.
way to put it, for private companies. So any type of stock that is issued, the company has everything issued through Carta. So um, all the stock for the employees, option pool, the stock for the investors, the preferred shares, all of that. And so you can see it's very transparent. So cap tables, yes, Mary, thank you. And so a cap table is basically just a list of all of the people who have ownership in the company. It's called a capitalization table. Basically, it's the capital that's been put into the company, whether or not it was in like dollars or if it was equity that people earned because they worked there. So a cap table is very something I always want to see very early on when I'm looking at a company, because I want to see how much cash they've brought in the past, who the other investors are, even if I don't know their names, like just like percentage wise, how much did they bring in? And then how much equity have they given out so far to other employees? How much do the founders have? It's always like kind of a red flag if you see like let's just say for example there's 3 founders and they each have 33% of the company to go in. Ooh, that's dicey, because now you're talking about the some one of the 3 founders is never going to pull their equal weight, and so you need to kind of figure that out ahead of time and not have that happen.
That's a really good thought, to ask for who are the other investors. I wouldn't have thought about that initially, but that's a really great question to understand, how much money have they raised? Who have they raised it from? Is it from friends and family? Is it from some institutions? I think that would give me a level of comfort, especially if there were some other institutions rather than,
Yeah,
the father, the brother, sister, whatever.
exactly. Yeah, right.
I
Because
think
those
Tina
are
has.
like obligatory. Tina, you have a question.
Not hearing you. You're muted. No. No.
I hate to, it's been a lingering question from earlier on in the conversation, so I hate to get us off track.
No,
But
please.
so when you were talking about the DAF, and you said that you could invest in a company, and as that company grew, your investment grew. But what if the company that you invested in failed? Does that have tax implications? Because now your core is less, and the money that you declared to the IRS as a donation is not there anymore. Is
No,
less. Like
no, it
you
doesn't.
claimed a
It doesn't
deduction for
matter.
something.
Yeah, I mean,
Pardon?
because the tax deduction happens at the time that you make the donation. It would
Mm-hmm.
just be like if Fidelity put it in a mutual fund and it lost money there too. So it doesn't have any tax implication to you.
Okay. Sorry, that was just a small detail, but
Yeah, no worries. Good question.
Yeah.
Russ?
Yeah, I wanted to say that I totally agreed with you about that SEC thing about accredited investor I think was done in 1933 or something.
Well, it was actually put together in 1982, but it's never been indexed for inflation. So if it
Yeah.
was, it would basically kick out like 70% of the angel investors in the country right now. So it's just
So it would
not.
be like 70, 80 million now.
What we determined was if they had indexed it for inflation since 1982, you would have to have about $600,000 in income and about $3.3 million in net worth. And
Yeah.
so that would kick out basically, from some rough math that we did at the Angel Capital Association, we figured it would kick out between 50, 60%, almost 70% of the population.
I'd love to talk more about that. I love the idea about the literacy and sophistication piece.
Yeah,
Yeah.
yeah, that's what we're trying for. Actually, the Angel Capital Association has put in a proposal to them to have classes that we already offer through the Angel Capital Association, and then there'd be like a simple exam at the end to just kind of prove that they went through it, and then they could be able to be what's considered accredited.
Okay, one last question, and Mary, you're it.
Thank you. Thanks, Marcia. Going back to the cap table and your comment about the founders, 3 founders all owning a third, I'd like to take it from a different angle. And is there a point at which founders can get diluted as more money comes in. So is there a point at which it concerns you if a founder is too little with what, doesn't have enough skin in the game?
Yeah, 100%. Yeah, that can be a very big problem. So, you always want to look at the founding team. End up talking to, let's say there are 3 founders. That's 2 is probably the most typical, but there are sometimes 3 too. So you want to talk to them individually and then as a group about what each of them is doing in the company, and then how the equity has been split, and making sure that everyone is kind of been taken care of. Because what you don't want is there to be like a divorce down the road, and because the marriage wasn't like really sealed up at the beginning between the founders, and then it gets very ugly. So if you have somebody, like, let's say one of them didn't get, to your point of the question, like, didn't get the amount of equity that they should have, there are ways that you can kind of come in and carve that out. I won't get into it now, but so that that would be kind of made up for. But in most cases, and you even want to see this with founders too, they hate it, but it's true, it needs to happen, is that you have pretty much all of the employees and even the advisors and board members on a vesting schedule. So they only get the equity as time passes and they've actually done what they said they were going to do. And most of the time that vesting schedule is a 4-year vesting schedule with a 1-year cliff, meaning that they don't get anything for the first year.
So we're out of time. And Marcia, this was so interesting. I could talk to you all day long, and I'm learning a lot. I really like the education that you mentioned Angel Capital Association has. I think that that's something that I personally am going to look into. But thank you so much. So everyone, we want you to sign up for Marcia's podcast, follow her on YouTube, read her book, and it is an easy book to read. It's informative. It is fascinating, and it's gotten me really curious about investing in smaller companies and seeing, because I'm very passionate about a few things, and I'd like to, make sure that doing good things in the world. And because of today's economy, I mean, it's like it could be a really good way to make a positive shift in our country. So
Yeah,
will you come back
we didn't
again?
talk about it. We didn't really talk about it, but angel investing doesn't have the level of volatility that you see in the public markets. So,
Yeah.
yeah, that's one thing that you don't really have the highs and lows that you're going to see like you're seeing right this very
Like we're
minute.
seeing right now. It's
Right
very
now. Yeah.
twitchy, as somebody said. The hiring market's twitchy, the stock market's really twitchy, and it's like, oh my gosh, where the heck are we going? But anyway, Marcia, thank you so much from the bottom
Yeah,
of my
thank
heart.
you.
Thank you.
Thanks